What's going on, guys? Jeff Weber here. I just had some funny calls with some investors, and they were going over because Foundation Capital, we offer 7% cash flow and 8% plus appreciation on the building. So you get a portion of the building's rent. You also get a portion of the building's upside. So that's what gets the 15% plus targeted annual returns. And the person, it was funny, I was on the call with, and they were thinking that they should be getting 7% every single month. And I'm like, well, I'm not Tony Soprano, because there are some criminal kind of loan sharking things out there, but a little delusional, the caller. But then I was like, okay, well, what's a good rate of return in Canada on investments? So I asked Grok here on Twitter, on X, and it's just it's interesting. So it's a little quick video today. You can see the benchmark returns in Canada in 2025. You can see the S&P and the TSX here. Historically, 9.3%. This is annual. So unlike the caller thinking that they can be getting 7% per month somewhere, which is just insane, would be 84% annually. You can see the TSX is producing here at 9.3. And they got a projection of 2025 to be 6 to 7% annually. And you can see here, and then you get into what generally private real estate investment trusts, REITs, are. And historically, remember, all this is buying apartment buildings, managing them, rent comes in, and the values of the buildings continue to go up if you have a high rent roll and low expenses. And obviously in Canada, rent is high right now, even though the news is saying it's dropping in the Toronto area, sure, but not along where Foundation Capital buys along the 401. So you can see historical, just REITs in general are producing 7 to 10% annually based on real estate funds and REITs from all the way from 85 to 2024. So that's a pretty good baseline of how REITs in Canada are operating here. So getting your 7 to 10 points. And 2025 outlook, just generally speaking for REITs, is expected 6 to 9% returns. And why it's relevant, private REITs are less volatile than stocks, providing passive income and diversification. A good, quote unquote, return is 6 to 8% with stable income, especially for tax advantage accounts like the TFSAs. And obviously you can make a TFSA investment with Foundation Capital. So you can check us out there. And obviously what we have is our 7% of cash flow, but then you get the building upside as well too, as we raise rent. And we're targeting 8%. So 7 plus 8, 15% plus is our target. And then just, again, Canadian bonds here, historical 5%. So you kind of want to diversify your investment portfolio, buy some stocks, the S&P 500, maybe get a couple Bitcoin in there, invest in the private real estate trust, the REITs, which are less, remember, this is the private real estate trust, not the public. Public's on the stock market, and that's why this one's private. It's not on the stock market, and that's why it's less volatile. And we're using your money to renovate the buildings and get the rents up so that the buildings can appreciate. So the historical Canadian bonds here, and your GICs are pretty bad. So you've got a GIC, liquidate that, get that into Foundation Capital, because we are just offering way more money than the 3 to 5% returns here in GICs. Talk to your parents and be like, why did I invest in GICs again? And then here's more, they should be criminal. The high interest savings account, you get a good old 2% to 4%. You're just going to lose all that to inflation as well too. So, and then you can also invest in the S&P 500 in CAD, in US stocks. You can see they're getting 12.1% annually, but their 2025 projection is a 6.6% annually, slightly below the historic averages due to higher valuations. And yeah, balanced portfolio. And so what is a good return? So a low risk, conservative, there you go. If you're just a low risk investor, go to your GICs, get 3 to 5%, get eaten up by inflation. Well, it says beating inflation at 2.1% with minimal risk. So you get 3 minus 2.1. So not going to get too rich there. So then moderate, 5 to 7, balanced portfolios like public and private REITs offer growth and income with manageable volatility. And then high risk, that's why high risk, because in the public stock market, although also it does say private REITs here, they fluctuate a lot more based on the news. and higher returns with the market fluctuations. Yeah. So private REITs in context, they return 6 to 9% annually. And advantages are they're stable income, low volatility. Then the stocks are tax efficient. You could do your TFSA, your RRSPs, your RESPs, your LIRAs. The risk, they're illiquid, so you do have to put in a redemption request to get your profits and money out. There's fees if for foundation capital, if you have a withdrawal request in the first year, there's a 7% withdrawal fee. In the second year, there's a 5% withdrawal fee. After 2 years, there's no fees. So ideally, you're making a 2-year investment in foundation capital, then you pay no fees on redemption. All right, so just something to think about there. It's just funny getting that call today, and they thought, I want to get that monthly, and it's like, buddy, no one's getting that monthly in all of Canada. So here's kind of your options. Diversify your portfolio. Consider investing in private real estate investment trusts. Watch some of the videos on a channel. You'll see us walking through the buildings. You'll see us turning the quote unquote bad units into good units, renting them out for hire. And that's literally the real estate investing game out there. So we'll see you guys in the next video.